Great. So I will be recording the session. We will plan to send this out to everybody after the session today. So if there are parts of it that you want to come back to, or if there are team members that you have that weren't able to join today, please feel free to share the recording with them so that they can go through the information. But thank you all for joining today. My name is Nimish Shukla. I'm going to be leading our webinar today. I'm one of the co-founders and COO at LifeRaft. And with open enrollment approaching, we're super excited to be talking about this last white paper that we wrote that really looks at, ICHRA, which has gained in popularity over the last 18 months versus some of the other options that are out there today, particularly level funded and self-funded plans. For those of us that are familiar with kind of each of those account types, there are some similarities, but there are also certain advantages and disadvantages to every single type. And so, really, what I'm going to be focused on today is a quick overview of each of the different account types. And then also, how do you really think about comparing these different options for your clients? If at any point a question comes up, please feel free to drop it into the Q&A. I will plan to leave plenty of time towards the end of our session to go through and answer any questions that do come up. But with that, I'm going to go ahead and get started and walk through our materials for today. So I want to start it with ICHRA, right? HRAs are a pretty broad umbrella, health reimbursement arrangements, and have been around for a number of years now. I think, individual coverage HRAs have really, again, gained in popularity, and I'll talk through some of the numbers a little bit later. But they've really gained in popularity for a few different reasons, right? I think number one has been the cost savings that a lot of employer groups are able to drive when comparing an ICHRA to fully insured group health insurance. But if you really think about the ICHRA and also the HRA more broadly, right? The advantage of an account like that is really going to be it allows an employer to set a contribution amount, and employees utilize it, right, in the ICHRA to purchase their own health plans, but also potentially to use those funds towards other eligible qualified health expenses, right? So there's no caps, there's no minimums. So it gives the employer a lot of flexibility and budget control when thinking about offering a health solution to their employees. And from an employee's perspective, right, there's actually a pretty big advantage here, which is when it comes to the health insurance options, it actually opens up selection for them. So rather than selecting where employers previously had selected carrier, effectively selecting network, and maybe three different plan designs. The ICHRA really gives an employee the freedom of choice. They can pick whichever plan makes the most sense for them, a network, the doctors, potentially hospitals that are going to be the best fit for them. And so it really is about increasing flexibility for both employers and employees. For those groups that are ALEs, right, that are applicable large employers that need to be ACA compliant, the ICHRA is really built to be ACA compliant. So not only can an employer really drive cost control, but they can make sure that they're compliant with ACA regs, make sure that they're offering affordable coverage if their ICHRA is designed correctly. So that's a high level overview of kind of the ICHRA. When we think about kind of features and some of the considerations when thinking about right an ICHRA and if that's the right account structure for a client that you might have, right? The first big one is flexibility. And we talked a little bit about this, and it's really flexibility for the employer and the employee, right? From an employee's perspective, they get to pick the individual plan that's tailored to their needs. One of the consideration I think that comes along with that, and one that we often hear and is completely valid, is the quality of the individual health plans going to be on par with what our group is offering today, right? We may offer a group health insurance plan today, and the deductible and out-of-pocket max and the networks are pretty good coverage. Are we going to be meaningfully deteriorating the quality of coverage for our employees if we shift to an ICHRA, right? So it's something that has to be really considered, and something that has to be looked at, and that's one of the things that we can certainly help with as you're evaluating ICHRA for clients. But it is, that is something that needs to be looked at. The other big, I think, advantage here is cost control, right? For an employer's perspective, they're able to set a fixed monthly reimbursement amount or budget, right, per employee, which offers them a predictable cost stream over time, even, right? So if you think about fully insured group health insurance today, what has been one of the biggest challenges that businesses are facing has been, as we get into October and early November, they're getting a renewal from their carrier. And if you're getting a double-digit rate increase year after year because of potentially utilization or not utilization, at some point that becomes really hard to continue funding. But also, when you think about the finance, the finances of a company, your P&L, their profit and loss statement, becomes heavily dependent on what health insurance expense is going to look like. And it becomes incredibly difficult to project that out to the future, which is really important for business owners. And so with an ICHRA, although there might be some, for those that need to be compliant, there might be, a couple of percent increase year after year on their budget. You're going to be able to really forecast what those health expenses are going to be over time, right? Um, I think the consideration with that is it really gives the employer limited control over coverage. Now, that's not always a bad thing. But I think really what it comes down to is the quality of the plans good enough for my employees, and are they going to be supported in really understanding how to enroll in health insurance? One of the other, I would say, advantages here is when you think about distributed workforces, right? What's happened over the last few years with COVID is companies have increasingly had distributed workforces with remote employees. And when using fully insured group health insurance, oftentimes you're having your remote employees join that group plan, and it may come with limited networks in their area. With an ICHRA, they really have the freedom of that choice. I think with the other options here, the key thing to keep in mind here is whether it's the administrative burden, whether it's contributions, there's increased flexibility for your employer groups. And that's really what the ICHRA is about. It's about cost containment, and it's about freedom, flexibility and freedom of choice. That flexibility for the employer comes through in both the administrative setup, it comes through in what benefits are actually going to be covered, right? Whether it's premium only, whether they want to cover premium plus other out-of-pocket expenses. Um, but I would say the two other key kind of things I want to talk through here are the tax advantages of the ICHRA. So from an employee's perspective, any dollars that they receive through an ICHRA are completely tax-free. They're not going to be they are not going to be added to an employee's W-2 grossing up their wages. It's a complete tax-free. From the employer's perspective, there are two key advantages, right? Number one, if you have a group that's just giving people a health stipend today, we have a lot of groups that do that. That's a really tax inefficient way to do that for both employees and employers. For employers, they're going to be paying FICA, Social Security taxes on whatever amount they're paying, or payroll taxes to whatever amount they're giving in a stipend. With an ICHRA for the employer group, they're no longer going to be paying FICA or Social Security. And in addition, any amount of money that's contributed through the ICHRA is going to be a benefit expense for the employer, much like their other benefit expenses are today. And the last thing I want to mention here is really, ICHRAs are scalable. We get oftentimes, what's a sweet spot for a company that should look at ICHRA? And, the real answer is there is no sweet spot, right? You can look at, we have employers that have hundreds of employees, pushing 1,000. We've got employers down to 1, 2 employees that are looking at an ICHRA because of the flexibility and the way that you can design the benefits. It really makes it a scalable solution. Now, again, from a consideration perspective, right? I think, we've talked a little bit about from an employee's perspective, it really comes down to, I think, the complexity of potentially choosing an individual health plan. And that can be overwhelming. And that's really where I think a good partner on the ICHRA side comes into play, whether it's yourself and you handle those enrollments, but having an enrollment partner and an HRA partner that can help guide your employees through that decision-making process so that it's not overwhelming can be incredibly important. Um, I think the other big thing here is uh, there is a portion here of potential out-of-pocket costs to employees. Now, I think to me that's really combined uh, with the complexity of potentially choosing a health insurance plan, but making sure that the employees understand their deductible and their out-of-pocket maximum, and that there might be some cost associated with the plan that they choose. So let's go ahead and talk about level funded plans. I'm sure a lot of you are familiar with level funded plans, but level funded plans are really, kind of a hybrid between your fully insured group health insurance, right, where the group is paying a monthly premium every single month, and the self-funded option, which we'll talk about in just a moment, where the group is taking a lot more risk. A level funded plan oftentimes combines kind of the two of those together, allowing an employer to pay a fixed monthly amount similar to the premium, and oftentimes include a layer of stop loss behind what they're actually paying into. Now, when level funded plans work well, right? If claims actually end up being low and there's low utilization, employers should be receiving a refund on the amount that they're paying in. But if claims are high, the stop loss insurance will kick in. And, you know, I think today these plans are, oftentimes marketed to offer cost control, which they do, a level of flexibility, which they absolutely do, and some savings when looking at comparing it to a fully insured group space, right? Um, those things are all absolutely valid. I think when we think about level funded plans, one of the things that we need to think about here, right, when we think about considerations, is there can actually be a lot more administrative oversight required on running a level funded plan, right? Not only is the regulatory system a little bit more complex depending on which state your employer's in, but oftentimes what you're really doing is you're changing the funding vehicle for a fully insured plan, but you're still giving your employees a group level experience, right? And there are advantages to that, but oftentimes they come with a lot of the considerations that you still see in the fully insured market, right? Fewer employee plan options. You're going to select a couple of plans that are available there. The big thing here is, I think oftentimes we think about it as it's a complete alternative to fully insured group health insurance, which it is an alternative. But really what we're doing here is we're just shifting the actual financial risk of the employer, right? In the fully insured group space, what you're doing is you're essentially pushing all of that financial long tail risk to the insurer. How you end up paying for that as an employer is if there is significant utilization over time, you start to eat into your long tail and those premiums are going to go up. What does actually happen, and what is a key advantage of full level funded plans, is if the same were true on a level funded plan, your monthly level funded, premium effectively may not increase as much as you would see with the fully insured space. However, one of the key considerations here is that actually will probably likely, if you start to hit your stop loss, is going to start increasing your premiums on stop loss, right? So whether it's a level funded, whether it's a self-funded plan, one of the key considerations here is that you're actually going to see stop loss premiums go up. And we saw that happen about a year and a half, 2 years ago with the stop loss market, right? There was such high utilization on stop loss policies that stop loss premiums started to go up. And so you have a similar challenge from an employer's perspective, which is although the level funded plan may provide a more predictable payment amount year after year, you really run into a similar challenge of being able to properly forecast what's happening, right? So if there is high utilization in a group, you're oftentimes going to continue to see an unpredictable increase in monthly payments, right? Whether that's fully insured or whether that's a level funded plan. Um, I think level funded plans do provide, some cost containment, and they do provide some predictability. But again, over time, they can provide um, uh, a lot of the same difficulty around projecting what's going to happen. And ultimately, they don't move health risk, almost completely off of the company's P&L, right? I think that's really the key consideration here to think about is when you think about the financial and health risk that an employer undertakes when offering group health insurance, whether it's fully insured or whether it's a level funded plan, there's still a significant amount of financial and health risk that an employer is keeping on their P&L and their balance sheet when they're offering an option like this. So when we think about, right, level funded ICHRA self-funded plan, level funded and ICHRA, and I believe we have a question that popped up. Um, and somebody asked, can you please review the employer contribution and participation requirements for ICHRA? Absolutely. I will do that in just a moment. Um, which is a good question. So let's talk about level funded ICHRA versus self funded, right? Three pretty different options. Let's start in the middle with the ICHRA, right? And this will, I think, answer some of the question that just popped up. So what is the ICHRA? The employer sets a fixed reimbursement budget, right? That's the funding model here. So we're not paying that to a carrier. There's no ASO contracts. There's no stop loss premium on the ICHRA. It's really, we're going to set a budget and we're going to put that in the hands directly of our employee. Now, how do they set that contribution limit, which speaks to our question, right? For those employers that are ALEs, that are applicable large employers, we're gonna set those budgets based on ACA affordability, right? We want to make sure that your employers are fully compliant, and so the contribution amounts, and this is what our platform can help with. The contribution amount um, is going to be based on the company census and annual wages to ensure that they're meeting the minimum affordability threshold that's set for Part B compliance of the ACA. But that's really how they set their budget, right? For groups that are under 50, they set that budget however they want to set that budget, right? It really comes down to how much budget does the employer think they have, and then we assist with designing a contribution plan for employee by employee that's going to make sense for their employees. Um, with the level funded plan, right, you're paying a fixed monthly amount that's oftentimes going to carrier going into the claims fund. You're going to have a carrier as an ASO on top of a level funded plan and a self funded plan, right? That are going to give you the network. They're going to provide the actual healthcare services, but that payment's still going in. And then oftentimes, even with a self funded plan, right? On our slide here, we have level funded plan, fixed monthly amount with stop loss. Your self-funded plan oftentimes is going to have stop loss as well. Um, I think the key point here really, right, comes down to risk responsibility. And this is when I'm talking about the health and financial risk. Where does that go, right? On an ICHRA, the employees bear the risk of choosing their individual plans, right? Now, the consideration there is to make sure that we have the right tools and right education in place to make sure that our employees are making informed, educated decisions. They understand what health plan they're selecting, but really that risk is transferred to the employee to some degree. With a level funded plan, right, it really is shared risk. It's the employer's taking on a certain amount of risk, and then oftentimes, depending on how that level funded plan is created, a carrier could be taking the risk or stop loss could be taking tail risk. With a self-funded plan, right, an employer is taking a lot more risk. Oftentimes, they are going to share that with the stop loss on the cap part. But there is, the employer is taking a lot more risk there. And a lot of times, although there's a cap, right, when I think about is there capped risk on a self-funded plan, if you think about it from are payments going to go up? The answer is yes, payments will go up. It may go into stop loss premium, but really you're leaving your risk uncapped with the self-funded plan. Um, what does that mean for cost management from an employer's perspective, right? On the ICHRA, it becomes predictable for an employer, right? Employees are going to pay excess premiums. So if my employees want coverage that is a platinum level plan and that exceeds the reimbursement that or the contribution that I'm making, the employee is going to pay for that, much like fully insured group health insurance or level funded or self-funded plans, right? Employees are going to pay a premium there. And so really, it allows that flexibility across each of these three plans, right? Um, I think the thing that the ICHRA does not provide, right, is a savings potential. Although there is some because ICHRAs are utilization based, so it's really based on participation in the ICHRA. But level funded and self-funded plans, there is an option for savings potential, right? If you think as an employer utilization is going to be below where you've targeted, then there is going to be some cost savings there. With an ICHRA, if participation is lower than you may anticipate, then there is going to be some savings potential there, but there aren't direct cost savings for the health utilization of your employee base. Um, Now, from a customization perspective, right, one of the other key reasons employers look at any of these plans is that there's um, there is an ability to fully customize benefits plan designs. With the ICHRA, that customization is a little bit different, right? You have some controlling customization over reimbursement or contribution schedules, right? And strategies there. But ultimately, because the health plan is really an independent piece of the ICHRA, there's health plan customization that's really driven by employee choice. But from a contribution perspective, there's quite a bit of customization. Now, the thing that this doesn't include that I want to make a note of is um, employers have the ability to cover health insurance premiums and other out-of-pocket expenses for their employees through the ICHRA. So there is a world in which an ICHRA, right, can be treated like a truly capped self-funded plan. And what I mean by that is an employer could say, hey, I'm going to give everybody $300 a month towards health insurance premiums. And we're also going to give everybody $2,000 a year towards deductible coverage, right? That is something that your employer can do. It's very similar to other strategies that may be out there, but really what you've done is effectively create a capped self-funded plan that includes health insurance premiums. Um, in terms of, employer size, right? ICHRA is incredibly flexible. It works down to one up through thousands of employees, right? When you think about a level funded plan, oftentimes it's going to be better for those small to mid-sized companies. I've seen groups, as small as kind of 20 to 25 lives up through about 100 lives use level funded plans. Larger plans can use them as well. And then for level funded, because you're taking on essentially health utilization risk at the company level, it's typically going to be better for your much larger clients, right? I say a rule of thumb is like north of 500 lives to ensure that if there is massive utilization, that it's not putting an undue risk on the employer's P&L. So one of the other things that we wanted to talk a little bit about today, and this is something that we've seen more and more of our employees do, is actually utilize a level funded plan combined with an HRA, right? I alluded to this on the last page, which is with an ICHRA, you can cover both health insurance premiums, but you can also cover other out-of-pocket expenses. This is a really interesting use case where we have employers that are continuing to use a level funded plan, right, for their major medical. And depending on the design of that plan, right, and by working with your carrier partner actually potentially narrowing a network or not covering things like fertility, right? Certain expenses that potentially are going to increase the cost of your level funded plan, but then layering an HRA behind that. And really, what that allows an employer to do is create that cap self-funded plan. So specific expenses can be covered within HRA. And really I think the power of that model is that it really comes down to utilization. So whether an employer wants to cover something like fertility, right? And this works with a fully insured group health insurance plan as well, by the way. Um, if they want to cover something like fertility, they can offer a $5,000 benefit per year towards fertility. Now, if employees don't utilize that benefit because they don't have a need for it, the business isn't paying for it, right? They set the budget, but there is no cost. If whoops, just go back. Sorry about that. If employees are not utilizing that benefit, then then there is no cost to the company, and so there's real cost containment. And from a maximum exposure perspective, right? If you think about modeling that out, it really would be considering a 100% utilization. So every employee is going to use our benefit, and they're going to use it to the maximum amount, right? So if I know I'm offering all of my employees $1,000 through an HRA for certain expenses, and I've got 10 employees, my maximum exposure is going to be $10,000 for that year through it. It could come below that. It could be the maximum it will be though is at $10,000. Great. So let's look at a quick case study here on a level funded HRA, right? So again, in certain cases, right? Um, uh, um, they have they've put into place an HRA that's focused specifically on IVF costs, right? So a client was looking at um, adding a fertility rider to their fully insured group health insurance plan. The fully insured group health insurance plan, the cost of adding that rider was prohibitive. It was raising everybody's premiums. And so the client really started looking at integrating an HRA into their level funded plan. And the way that we structured this with the employer is the employer was offering $5,000 per employee for IVF expenses. In this instance, the employer was actually able to um, secure a carve out stop loss for a portion of those IVF expenses given the size of that company. And so really they were offering $5,000 of benefits towards the IVF expenses, all coming from the company, right? But there was a backstop on a certain tail part of the risk there. And so what that did is it helped reduce some of the strain on employees, right? They got $5,000 a year towards IVF expenses, but it also helped reduce the exposure that the company was going to face. Looks like we have another question. Are you sending the slides out to us? Yes, we're going to be sending a recording of the session out after. Um, what I wanted to talk about here with the last few minutes, and then I'll save some time for additional questions here, is really what we've been seeing from an HRA perspective. So new data has been published. We're seeing similar trends, but HRAs have really started to pick up steam across the board. And I think the big change between 2023 and 2024 has been that change in ALEs or applicable large employers utilizing ICHRAs. If you look at from 23 to 24, ICHRA adoption in that market grew 84%. And so I think what you're really seeing is the market is starting to value the idea of being able to cap a company's exposure and ultimately give the employee more choice in terms of the plans that are available to them and what they choose to select. And so that growth in ALEs is actually driving, I think, writ large growth in the market. And it looks like we are we are poised to have another really big open enrollment with the account types. So you're starting to see companies really take advantage um, of the ICHRA, the QSERA, and other HRAs as viable solutions to be able to fund health insurance premiums. Um, when we look at kind of 2025 and this open enrollment period, right? Where are the opportunities for growth? I think number one, continued cost pressure in the group market. So we've continued to see this with clients that we talk to, broker partners that we work with. Groups are facing more and more cost pressure in the fully insured market, and I think that's actually going to drive all parts of this market. Um, it's going to drive, I think, level funding. It's going to drive self-funding, right? But it's also going to drive HRA growth. And so I think, that cost pressure is a really good opportunity for us as a broker community to be exploring alternatives, right? And really understanding which account structure and which account type is going to be the best fit for my employer groups. Um, the other thing I think that's going to potentially drive real adoption here is, the possibility of future state incentives for HRA utilization. So we've already seen one state adopt this, right? Indiana last year, the state legislature passed a $300 tax credit for any small business that was offering coverage through an ICHRA. If that works and drives HRA growth, I think it's possible that we're going to see more of that next year. Now, I think there is some uncertainty around the election and the next administration, which could drive a level of uncertainty here. But I do think, the ICHRA seems like it's poised to stay. There is bipartisan support of the account structures and the legislation there, so it does look like it's poised for continued growth as we head into 2025. Um, what are some other areas? I think number one, right? Similar to that case study we just walked through, I think a lot of it is around customization. So, what we're seeing in the market today has been a lot of growth on what I call premium only ICHRAs, right? Companies that are looking at the ICHRA simply as a way to reduce costs, which is very, very valuable and very powerful. What we haven't yet seen broader adoption of is, I think, a complete understanding and customization of benefit programs utilizing the ICHRA as a chassis, given how much flexibility there is, right? There is significant cost control available to employers that are utilizing an ICHRA for premium only, but there are also other opportunities of cost control when we think about wrapping in other benefits. And so I think as a broker, as broker community becomes more familiar with HRAs and some of the creative things that we can do with them, there's a real opportunity for growth there. And the last one here is really technology improvement. I think we talk about this a lot um, as um, as an HRA administrator, right? As you start to see technology improve from the administrator community, and really it starts to lean into brokers and PEOs, I think we're going to start to see some real growth here. Um, one quick mention here, right? From our perspective as LifeRaft, our platform is designed and was designed intentionally to be as flexible as possible when it comes to HRA accounts. So we are able to we're able to administer and offer any type of HRA, and really be your thought partner in what is the right way to design these, right? So when thinking about, ICHRAs and QSERAs for health insurance, right? ICHRAs are going to be um, a really good fit for those companies that don't want a yearly contribution cap, that are ALEs, uh, and are looking for a flexible health solution. QSERAs are going to be right for those small businesses that have less than 50 full-time employees. There is a contribution cap there, but there are some pretty big flexible, I would say, flexible levers with the QSERA that are really designed for those small business owners. Now, there is also the standard HRA, the group HRA, sometimes, called integrated, sometimes called group HRA. And really it's the account is designed to be offered alongside a group health insurance plan, right? So this is not meant to replace group health insurance, but really is meant to help employers offer out-of-pocket coverage towards certain expenses sitting alongside that group health insurance plan. And so that's really where a significant amount of flexibility lies for groups, and one of the areas that we can really be helpful with. So with that, thank you guys so much. That's what I had prepared. I will leave, uh, stay here for a few more minutes. Happy to answer any questions. Looks like we got one question. Uh, isn't classing by age considered discrimination? I didn't know you could do this. It's a good question, Kim, and you cannot class by age because that is considered discrimination. What the ICHRA does allow you to do, though, is it does allow you to offer a higher reimbursement for your older employees, but it cannot exceed three times the youngest employee. So, to put this into an example, because individual health insurance is age rated, what that means is your 60-year-old employees are going to be paying more for health insurance than 30-year-old your 30-year-old employees. So to be able to account for the fact that individual coverage is age rated, the ICHRA regs do include the ability to offer older employees more a higher reimbursement. But again, it can't be more than 3x your youngest age group. How we handle that and how we look at that at LifeRaft is we always take into account the 3-to-1 to ensure it's never exceeded. But really, particularly for those ALEs, larger employers, we actually run the entire census through to set an affordable contribution structure and then adjust within age classes as we need to make sure that one, affordability is met, and two, that we're not running into any discrimination. From a classing perspective, um, there are 11 approved classes that are available, and that really comes down to who's offered the ICHRA and who's not potentially offered the ICHRA. And so that's completely different than age. So we had a question: does your company handle the individual enrollment to the carrier, or does a broker have to enroll the member in the plans? Yeah, great question. So from an ICHRA perspective, we designed our platform and our customer experience with our broker partners in mind. So we have a number of broker partners that want to continue doing and have the ability to do the individual enrollments and want to be agent of record on those individual enrollments. So in that case, we allow our broker partners to do those individual health enrollments. If it's not something that you want to do, then we do have a self-service option that's available through the LifeLock platform where we can assist. We also have uh, we have enrollment partners that we can bring in on a case-by-case basis that can provide a white glove service to your employee base. Great. Thank you for the questions. I'm going to go ahead and stop the recording.